Welcome to the Deep Dive. Today we are cracking open the Q3 2025 earnings call for Privia Health Group, ticker PRVA.
And this one is really interesting.
It is, because you have this classic case of just incredible operational execution meeting, well, a very skeptical investor base.
Exactly. Management comes out, they post these massive beats, they raise guidance, and the stock actually goes down the same day.
So that's the tension right there. Our mission today is to figure out what spooked the market.
Right, because Privia is a top name in physician enablement, in value-based care. And when you see a reaction like that, you know the market is looking past the quarter and seeing something else. Maybe something they don't like about the long-term story.
Okay, so let's jump right in with that snapshot, because the scale of these beats, I mean, it's hard to overstate.
They were really exceptional.
Revenue for the quarter came in at $580.4 million. That's a 32.5% increase year over year.
Which is already strong, but the key is how it compares to expectations.
It just blew past the Wall Street consensus. We're talking by $80 to $85 million. That's a 16 or 17% beat on the top line.
And that momentum, it didn't just stop at revenue. It flowed straight down to their adjusted profitability.
So adjusted EPS came in at 29 cents, just crushing the consensus of 22 cents.
A 34% beat. I mean, you see numbers like that, you expect the stock to pop instantly.
So why didn't it? That's the core conflict, isn't it? How does a company beat revenue by 17% and adjusted EPS by 34% and still end the day in the red?
Yeah, that's the big question. And if you want to be really technical, they did miss on GAAP EPS by a penny. 5 cents actual versus 6 cents expected.
But come on, a 1 cent gap miss? That's just noise, right?
It's basically noise. The market for a company like this is looking at adjusted metrics, at cash flow. So what it tells you is the skepticism runs a lot deeper. Investors just weren't convinced that this kind of margin performance was repeatable.
Show me story. They want proof of long-term leverage, not just one great quarter. Okay, so let's follow that profitability thread. Management was banging the drum on operating leverage. How did the margins actually look?
The leverage story is very clear in the numbers. Operating income was up a massive 148% year over year. It hit $14.4 million.
Wow.
Adjusted EBITDA was up 61.6%, hitting $38.2 million. But the metric I was really focused on, adjusted EBITDA as a percentage of care margin, that expanded by 720 basis points year over year.
720 basis points. That's huge. So for our listeners, what does an expansion like that actually tell you about the business model?
It tells you that it's working. It means the cost of adding a new doctor or a new patient life is going down fast. They're scaling all those fixed costs, the tech platform, the billing, the analytics, over a much bigger base.
So they're getting more efficient as they grow.
Significantly more efficient. They're spending less to earn each dollar of revenue, and that's what drives profit so much faster than just top-line growth. It's the definition of platform leverage.
Right. And you can see that in the operating metrics that support all this.
You do. They had dual growth engines. Implemented providers hit 5,250. That's up about 13% year over year. And then value-based lives, they hit 1.4 million, also up about 13%.
Okay, so the platform is growing at 13%.
Right. But here's the kicker. Practice collections, the actual money flowing through their systems, grew 27.1%.
Wait, okay, so providers grow 13%. But the money flowing through grows at 27%. That gap is really important. What does that signal?
It signals incredible health. It means, first, the existing doctors are using the platform more, probably seeing more patients. That juices the fee-for-service side. And second, it implies they had better than expected results on the value-based care side. The engine is just running much, much faster.
And that engine, a big piece of it anyway, is the Medicare Shared Savings Program, or MSSP. This is where the real value is created, isn't it?
It's the core of the value-based profit story, and their 2024 results were, frankly, outstanding. Their 9 ACOs managed over $2.5 billion in medical spend.
And their savings rate.
It jumped to 9.4%, up from 8.2% the year before. That created $234 million in total shared savings. Privia's gross share of that was $160 million.
Increasing your savings rate by over a full percentage point on that kind of spend is... well, it's not easy.
It's incredibly difficult. And they highlighted their Mid-Atlantic ACO, which hit an 11% savings rate. And get this, it's the 5th year in a row it's been the highest performing large ACO in the country.
It's not a fluke.
It suggests a real structural advantage in how they manage patient health. But this brings us right back to that core market concern. sustainability.
Can they do it again?
Exactly. And management knew they had to address this. They confirmed that this amazing 2024 performance is now baked into the baseline for all their future guidance.
So the bar is now set much higher for next year.
Much higher. To get those same savings again, they can't just rely on favorable benchmarks. They have to get even better operationally every single year. They're basically telling investors, we know the challenge just got harder and we're ready.
Okay, so moving from operations to strategy.
Yeah.
They also confirmed a pretty big acquisition. It seems like they're putting that strength to good use.
Yeah, the Evolent deal. They're buying Evolent Health's ACO business for $100 million in cash upfront, plus a small earnout.
And this isn't just a small bolt-on acquisition.
Not at all. It's a major strategic expansion. It adds over 120,000 patient lives across MSSP, commercial, and MA, and it gets them into 6 brand new states.
And they expect it to add to adjusted EBITDA starting in 2026, which is right in that time frame that investors are so worried about.
It is. And the reason they can do a deal like this comes down to one thing: their balance sheet.
Which is pristine.
It's enviable. They ended the quarter with $441 million in cash and 0 debt. Even after paying for Evolent, they'll still be sitting on over $400 million in cash.
And management was pretty clear they intend to use it.
Oh, yeah. They said they're going to be aggressive and opportunistic. They see other models struggling out there, and they plan to use that cash pile to their advantage. But they also stressed they'd be disciplined on price. Having that much cash with no debt gives you the power to be patient.
Right. That optionality is a huge advantage. Let's talk about the guidance, because they basically put their money where their mouth is.
Their confidence really came through here. They raised the full-year GAAP revenue outlook to between $2.05 and $2.1 billion.
And more importantly, on the profit side.
Adjusted EBITDA guidance was raised to a range of $118 to $121 million. The midpoint there implies about 32% year-over-year growth.
And they also talked about cash conversion, which is key for a lot of investors.
They did. They reiterated that they expect over 80% of that 2025 adjusted EBITDA to convert directly into free cash flow. That's the fuel for future M&A.
Okay, let's touch on risk management, especially around Medicare Advantage.
Yeah.
The whole MA world is facing some serious headwinds.
It is. You've got the V28 risk adjustment changes. You've got utilization spiking. It's a tough environment.
And Privia's approach
is very, very defensive, and I think very smart. Management was clear they are keeping a cautious posture on full risk MA. They only have a tiny book of about 20,000 capitated lives. They much prefer shared risk models where their downside is protected.
So they're trading some of that massive upside for, for stability.
Exactly. They are deliberately insulating themselves from the pressures that are just crushing some of their peers right now. Companies in full risk deals are getting squeezed on their medical costs. Privia is sidestepping that problem almost entirely. They're choosing quality of earnings over risky growth.
So beyond risk management, what's the long-term plan to, monetize this platform they're building?
The plan is all about density. As they get more and more doctors on their platform in a specific city or region, they plan to layer in what they call ancillary services.
Things like labs or surgery centers?
Exactly. Labs, pharmacy benefits, ambulatory surgery centers. It creates new revenue streams, sure, but it also makes their platform stickier for doctors. They become a true integrated partner, not just a tech vendor.
So if we put this all together, massive beats, expanding margins, a big strategic deal, raised guidance, a fortress balance sheet, and a really smart defensive posture. Why the sell-off? What is the single biggest hang-up for the market?
It all boils down to the market being in show-me mode. They're fundamentally questioning the durability of those margin gains.
They think that 720 basis point expansion was a one-off.
Or that the MSSP savings were a cyclical high. Investors need to see proof that this platform leverage is real and that it will show up again in 2026, especially after they add all the Evolent lives into the mix.
It's such a disconnect because you look at the sell-side analyst and they love the story. Their price targets are all pointing way higher.
They are. The analysts see the operational execution, but the big institutional money, they're waiting. They want to see the Evolent integration go smoothly, and they want to see those MSSP results repeated on a harder baseline. The thesis is sound, but the market wants proof.
That uncertainty plus that huge pile of cash creates a really interesting divergence. And that brings us to our final segment. This is not financial advice. Let's pitch an outrageous but plausible trade idea here.
All right, so the thesis is simple. Privia is a clean execution story with a perfect balance sheet. Meanwhile, a lot of the full-risk primary care companies are getting hammered by MA headwinds.
The very headwinds Privia is avoiding.
The very same. So you have a clear divergence in quality and risk profile.
So how do you trade that?
You set up a high conviction relative value pair trade. You go long PRVA, which is underperforming right now because of this market skepticism we've been talking about, and you fund that long position by shorting a diversified, highly levered, full risk primary care competitor.
So you're betting on quality and shorting the leverage and risk. What's the catalyst that makes this trade work?
The catalyst plays out over the next year, probably into mid-2026. On the long side, Privia proves they can integrate Evolent and they deliver strong MSSP results again. The market is forced to re-rate the stock higher.
And then on the short side,
the MA headwinds just keep blowing. Utilization stays high, the V28 payment cuts bite deeper, and the over-leveraged peers start missing their numbers. You get multiple contraction on the short and multiple expansion on the long. It's a pure bet on disciplined execution versus a high-risk gamble.
A compelling trade. That wraps up our deep dive on Privia Health's Q3 2025 earnings.
And to recap, it's really a story of stellar operational performance running headfirst into a skeptical market that's demanding proof of long-term durability.
So the final provocative thought for you to chew on. Management said they're going to use their $400+ million in cash to capitalize on market dislocation. The most pain and dislocation right now is in that full-risk MA sector. So the question is, which of those struggling, highly levered primary care models could become Privia's next big acquisition target?
That's a great question. Keep an eye on the weakest players in the space. They might just be PRVA's growth story for tomorrow. Thanks for joining us. We'll be back soon with another deep dive.